Hello everyone, this is Justin Smythe from nextbigtrade.com. This is the index review for March 7th, 2025. The S&P 500 was down just over 3% for the week last week and had its first close below the 30-week moving average since the October 2023 correction bottom, which really launched the massive rally that occurred throughout 2024. As we've discussed in the past, there were multiple corrections that occurred in 2024, but they all held the 30-week moving average. Corrections tend to at least move the S&P 500 back down to the 30-week moving average, which is why 2024 was a little bit unusual. It was so strong that the market had an easy time actually holding above the 30-week moving average on the correction in April. And then the biggest correction in July, it penetrated it but closed above by the end of the week of the last week of the correction. And more recently in December, we had a recent correction that held the 30-week moving average, but we rallied back up, had a failed breakout attempt, and then we've been in correction now for 3 weeks. Some pretty big volume coming in during this correction, indicating, a pretty big change for the market. And really, even before the selling the last 3 weeks, there was lots of volume, lots of churning, and then the market failed to break out and broke down. We'll zoom in on the daily chart, and interestingly, the S&P 500 moved below an important support level this week. This is where the S&P 500 pivoted during the election, U.S. presidential election, where initially it was actually moving lower heading into the election, but it rallied strongly after the election and kind of continued that rally until early December 2024, where it went into correction. But again, that December correction pivoted strongly around the same support area, had a really strong rally coming out of that correction, but then a lot of sideways churn. And then again, we had that failed breakout just a couple weeks ago, which ushered in this fast move lower now. And now we've gotten to the point where we've gotten below this same support level, which is now the 30-week moving average. So it's very important to see what the S&P 500 does. If the S&P 500 rallies up a little bit here more and fails at this level, that would be a very bearish indication that really it's can't fight through any of this former support, which is now resistance, and it turns lower. So again, we've got an important upcoming test for the S&P 500 to see if it does bounce here. How does it act around this former support level? That, does it break through it, or does it find it as resistance? That would increase odds we would roll over. And overall, as I discussed in the newsletter, I don't see anything that's indicating this correction is over yet in the stock market. There needs to be a strong sector move with powerful stage 2 breakouts to bring the market out of a correction, and that is just not occurring quite yet. Technology was underperforming the S&P 500 this past week. That's also bearish for the market. You can see big volume coming in. NASDAQ 100 is now down 10%, over 10%, which is pretty substantial for just a 3-week correction, closing below the 30-week moving average this week, and again underperforming the S&P 500. On the daily chart, again, we've broken through kind of that same support area that was in place before the election, then during the last correction, and then just knifing through it. You can see how sellers have just had complete control of this market. All the price action is occurring below the 10-day moving average, which is the fastest moving average on this chart, it just shows how the markets had no ability to rally at all. We could see some type of rally. Perhaps it started on Friday, but again, if it fails, especially around the 30-week moving average and around the support level, that would be bearish for the stock market. NASDAQ Composite breaking through 30-week moving average, underperforming S&P 500, all bearish action. And the Russell down over 4%, big volume. Really nothing good happening here. And the Russell has just, went from a breakout attempt to failure. And now we're moving lower, rolling over into stage 4 potentially here. Turning to the VIX, this is another bearish indication for the stock market. We're rising above a rising 10-week moving average, breaking out of this basing pattern. The VIX has a monster basing pattern really here and had a huge spike during that July 2024 correction. Nothing really seems like it's stopping the VIX at this point, and we could see even more volatility for the stock market in the upcoming weeks. Breadth is not good for the bulls either at this point. It has moved lower, but there's still almost 50% of stocks above the 50-day moving average. Typically during corrections, you see breadth get to an oversold level. However, that didn't really occur much in 2024 with the strong market. It got at its lowest during the April correction, and then it kind of moved lower again during the August correction. But during that December correction, we did get oversold, but now we've got plenty of room to move lower. Even though we've had a substantial correction so far, we've got plenty of room for stocks to move lower before odds of a bounce get a little bit higher. Same thing with the 20-day moving average, still not oversold yet. Even with an 8% move lower in the S&P 500, there's still 44% of stocks above the 20-day moving average. So this has plenty of room to move lower. And then more concerning, I've talked about this chart recently, but we're going to bring it up again. This is the lowest close for the percentage of stocks above the 200-day moving average at 52% since the bull market really launched again in 2024 after that October correction. This is where the market was looking really dicey, looking like it could roll over into a bear market again. And then instead the market blasted off into the 2024 bull market. But now we're getting into that intermediate zone, and if stocks continue to deteriorate and start spending a lot of time below the 45% level, this is where bear markets occur. You can see how in 2022 the percentage of stocks above the 200-day moving average stayed below 50% for a lot of that bear market, which means most stocks are in a downtrend, and that's what causes the overall S&P 500 to be in a downtrend. And, obviously this was a terrible environment to trade to the long side for about a year during that bear market. So if we start living below the 45% level in 2025, that would mean that we're in a much more hostile environment, more like 2022, where, defense is much more important and just kind of staying alive and not losing too much until the market is in a more favorable position. So again, a thing to keep an eye on as this correction continues, like how many stocks are now trading below their 200-day moving average. Finally, the advanced decline line for the NYSE rolling over again below the 10-week moving average. That typically occurs during bearish markets. That occurred during the 2022 bear market. And then we trended above it during the 2024 bull market. So when more stocks are declining than advancing, obviously that's a bearish market. And we've got a stage 3 topping pattern here too with this indicator. So if we roll over into stage 4, that's another indication again that we're transitioning into a more bearish market. So bottom line, no evidence this correction is over. Actually, the bear case strengthened this week. And as we'll discuss in the sector review, there's more shorting opportunities, and it's really the name of the game right now is staying defensive, perhaps for multiple weeks to months here until this correction is over.